There you have it, the closing bell at the New York Stock Exchange, capping off another day of trading on Wall Street. Once again, the Dow is in the red, down about 112 points. This comes as the Dow continues to flirt with bear market territory.
The S&P's down for about 0.25%, while the tech-heavy NASDAQ is about 0.25% low as well. Neil Irwin joins us now. He is the chief economic correspondent for Axios. Neil, now that there's more confirmation that Wall Street may have hit a bear market, and we've been talking about that for a while now, how will that change just the mindset for investors moving forward?
I mean, look, these have been major losses that investors have incurred over the course of 2022. I would add it's not just stocks this time. Usually when the stock market drops, often bonds rise. And this time the opposite has happened. Bonds have been falling as well. So even if you have a balanced portfolio that's supposed to be nice and safe and steady, zig when one thing zags, you're not getting that right now. So basically across the board, you're seeing losses, domestic, international, stocks, bonds, across asset classes. So it is a rough year for any investor.
So what are some of the steps that Americans who are concerned about this right now can take to protect their financial interests, retirement funds, et cetera, during a bear market?
Well, the truth is, if your money is for the long term, if it's money you're saving for retirement, for something years and years away, it probably makes sense not to cut and run the minute you see a decline. People tend to sell at the worst possible time when in those kinds of situations. That said, if there's money you need in the not too distant future, if it's for down payment on a house in a couple of years, some things like that, you probably do want to be in safer investments that are not going to lose money the way stocks and bonds have this year. So cash being the prime example, that's actually where you see some returns right now. 6 months ago, cash paid 0%. Now we're at almost 3%, depending on the exact account. The Federal Reserve is pushing interest rates higher still, might be more like 4% by the end of the year. So, cash is something that actually is starting to pay a little bit of return, and you aren't going to lose that money if in the event that things keep selling off on Wall Street.
Now, I want to turn you to the global economy. Yesterday, we were reporting the British pound fell to a historic low, putting more pressure on the Bank of England to consider another interest rate hike. What impact would you say these rising interest rates in the UK have on U.S. markets?
So the situation in Britain is really interesting because it's basically Britain is behaving kind of like an emerging market normally does, and acting as a source of contagion and a sense of higher risk for the entire world economy, the entire world financial markets. London is a major financial hub. This a series of kind of escalating, falling currency, rising interest rates is something that's really stressing the global economy and contributing to this sense of higher global rates means a gloomier situation for investors, gloomier situation for the economy. So the news out of Britain is not good for Americans. That said, it is kind of causing the dollar to rise. So if you're planning a vacation overseas, certainly to London, you are in pretty good position coming in this next few months.
All right, Neil Irwin, thank you.
Thanks so much.